I really want to help you pay your mortgage off early. I want you to understand the power of compound interest and how you can get ahead of the curve. There are several quotes attributed to Albert Einstein about compound interest. One of them is, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." Whether or not Albert said that, compound interest can work for you or against you in big ways. I want to help you understand how compound interest is affecting you through your mortgage and how you can minimize its effects. Okay, so let's get started. Anytime you see an orange cell, that's an input. Everything else is calculated. Okay, so what you want to do is call your mortgage company or go online and find the payoff value on your loan, and you'll put that here. That's the principal remaining. Let's say it's $200,000. Then you put your annual interest rate here. We'll say it's 3.49%, but you fill it in with whatever yours actually is. Then if you have PMI, just put that here, 20 bucks. We'll say you do, and it's 20 bucks per month. Okay, here you want to put your annual insurance, and below that your annual property taxes that you pay on your house. Okay, and then down here in cell 8, C8 and D8, you want to put the time remaining on your loan. So say that you had a 30-year loan and you've paid on it for 9 years and 9 months, and so that would leave you with 20 years and 3 months left on your home, so you would put that here. Okay, and when you fill that out, this number down here in red, the red highlighted number here under total monthly payment, it should be $17.69. That should be approximately what your total monthly payment is. Okay, now this is where Albert's words can be ringing in your ears. As you look up this table, you see what you would have to pay in order to pay your loan off in this many years. So, for example, if you were to pay $2,048.78, you'd pay your loan off in 15 years instead of 20 years and 3 months. This is one of the main reasons why I wanted to make this spreadsheet available to you, because this is something that really helped me to really gauge as I kind of see where I am here at this point, and then to look up this chart and really see how just a little bit more money can really make a big difference on knocking years off of the loan. So say that you just paid $100 more a month. That would put you about here, just $100 more a month. That would knock 2 years off of your loan. And then you really start looking at some of these other numbers, well, what if I could do 400? Where would that put me? And you look really fast, and this would put you somewhere in this ballpark here. So now you're talking about you'd be around 14 years. So you'd knock 6 years off of your loan just by paying that extra $400 a month. And so, say that you did get a 30-year loan and you have been working for 10 years and working on it for 10 years, and maybe now you're at a different point in your life where you can afford a lot more in your monthly payment. And so, that's where you can really go up this chart and really find a number that you're comfortable with paying more each month so that you can um, knock time off of your loan. And I really would encourage you to really use this part of the spreadsheet. This is like I said, the main reason why I made it is so that a person can start here at the red, this red row here, and really look up and basically in their heads, just subtract the difference between this value and this value, and that'll tell you the additional principal that you'd have to pay in order to pay it off in this many years. So, then you could say, well, what if I could do $600 more? Well, what would that put you at? That'd put you around somewhere in this area. So you're talking somewhere between 11 and 12 years. So, and you can do that until you find an area that's comfortable for you. In our case, let's just, for an example, let's just say that you've done that and you've seen these values and you say, okay, I'm approximately $3,000 a month is what I can do for a mortgage payment. So that would put you in this range here, 8 years. Now let me point something out to you real quick. You see this 2780? Now when I change this to 9, you'll notice that will slightly change. And the reason for that is these loan years assume 0 months. So 2 years and 0 months, 3 years and 0 months, 4 years and 0 months, etc. The only way that that's overridden is by changing this value here. So let's just run through another quick example so you can see this. So if I change this to 0, you see how 8 years is at 3010. So now if I change this to 8, that remains the same at 3010. So the only way that that value of the blue cell is going to be overridden is if you change this months to something other than 0. So let's just say, if you made it 1 month, then it would be this value here. It won't affect any of these others, and so the reason why I did it that way is so that you could quickly get an approximation of where you are in your comfort level as far as total monthly payment, and then you can fine-tune it with this month value here. So say you've gone through the fine-tuning process a little bit and you've really kind of honed this number in on something that you're comfortable paying more each month. And by the way, you can either look at this number if you want to think about it in terms of how much additional money I would have to pay each month towards my principal, or what my total monthly payment would be. This number here, this 1220, is just this number, 2989 minus 1769. So you can either think of it either way, total monthly payment or additional principal. It is the same thing pretty much. Okay, so say that you've gone through this process and you fine-tune it a bit to where you've said, okay, 8 years and 0 months, 1241 additional. That's a little bit more than I want to pay. Let's try 8 years and 2 months. It's approximately $1,200. I can pay a little bit more than that. Let's try 8 years and 1 month. Okay, 1220. All right, that's pretty good number right there. I feel comfortable with that. I think I'd like to do that. I think I'd like to pay that additional amount each month. And so what that'll mean is that you will pay your loan off in 8 years and 1 month instead of 20 years and 3 months. And in the process, you will have saved this number right here. So in this case, it would be $49,000. Imagine that. $49,000 that's not going to the bank, it's going to your pocket. This is additional information if you want it. This is called the amortization schedule. So, by the way, here's an orange cell. So if you do want to use the amortization schedule, what you do is you put in the date of your next payment here, and this will outline each payment of those payments in your desired remaining years. So like in this case would be 8 years and 1 month. So it'll outline each payment within those 8 years and 1 month. So it would be basically 97 payments, and you can just watch your balance fall all the way down to 0, and it'll tell you your principal, how much you're paying in principal each month. It changes, it goes up. How much you're paying in interest each month, it goes down, and what your total monthly payment is, which always it stays the same. So that's there if you want it. Okay, I hope you enjoyed this video. Please subscribe so you can get notified when I post more videos. If you'd like to purchase this spreadsheet, please see the link in the comment section.